So this is my first time to Israel, and I'm very happy to be here. And thank you, Dan and Shlomi, for the invitation to come and speak. So I come from the U.S., where we started the Chartered Alternative Investment Analyst Program, or CAIA. And so CAIA was started in 2002, and now we have over 10,000 members in 90 countries who've completed our one-year-long professional designation in alternative investments. About 50% of our members are in the US and Canada, about a third in Europe and the Middle East, and then the balance are in Asia. So we have a level 1 and a level 2 exam that are offered in March and September, and you can take that exam here in Tel Aviv, and we do have members and candidates here in Israel. It takes about 400 hours of study over the course of 1 year. It's a globally competitive exam where about 60% of the candidates will pass in any given period. We also have a shorter form course called the Fundamentals of Alternative Investments. It's a 20-hour video program that's designed for a 100% pass rate. And so you have 5 hours of material on hedge funds, 2 hours on private equity and venture capital, 4 hours on real assets like real estate, commodities, and farmland, and then we look at credit derivatives as well. This is meant as an executive summary course or a continuing education course. So when we look at alternative investments, the idea is to have something in our portfolio that's different than stocks and different than bonds. And one of the key issues with stocks and bonds is that stocks and bonds tend to underperform during times of rising rates and during times of rising inflation. And so what we'd like to do in alternative investments are to find things that aren't stocks and find things that aren't bonds to put into our portfolio. And so we have these categories of alternative investments. So very broadly, we can invest in hedge funds, we can invest in private equity and venture capital, and then we can invest in real assets. It might be farmland, timberland, infrastructure, real estate, commodities. All of these are available forms of investments that we can find in institutional portfolios and increasingly in individual portfolios as well. So all of these returns are in US dollars, and they reflect the strength of the US dollar against many other currencies over the last 10-year period. But focus on the second 3 lines. You see the MSCI World Equity Index and then the Barclays Global Aggregate Bond Index. And so a traditional investment portfolio might be 60% invested in global stocks and maybe 40% invested in global bonds. And that gave us a return of about 6.6% over 10 years with a standard deviation or volatility of returns of 10.5%, or a drawdown of a peak to trough loss of over 30%. And so this is the standard investment opportunity set for many investors. But look at what happens when we put this alternative investments into the portfolio. So our global invested alternative asset portfolio towards the bottom, this is 1/3 in hedge funds, 1/3 in private equity and venture capital, and then 1/3 in real assets. So when we mix those together, the 10-year return is 7.7% with a volatility of 6.6% and a drawdown of 21%. So compare that to that global portfolio that's invested 60% in stocks and 40% in bonds. Not only do we have a higher return in the alternative investment portfolio, but we also have a lower standard deviation and a lower drawdown risk. So there's a significant risk reduction potential. Now, besides David Swenson and Yale University, most investors won't invest 50 or 100% of their portfolio in alternatives. Maybe 20% is a more reasonable allocation. So the bottom line here is if you invest 40% in global stocks, 40% in global bonds, and then 20% in this portfolio, that's a third in real assets, a third in hedge funds, and a third in private equity and venture capital. Now you've got a return of 6.4%, pretty similar to the return of 6.6% on that 60-40 portfolio. But look at what happens to your risk. The volatility goes from 11% down to 8.5%, and the drawdown goes from 30% down to 25%. So even if you hold alternative investments at a 20% weight in your portfolio, you could have a substantial risk reduction impact without reducing the expected return on your portfolio. We've tried to count all of the money in the world. And so in the traditional world of stocks and bonds and cash, we count about 98 trillion US dollars as a global invested wealth. And now we see about $14 trillion in alternative investments. So now 13% of all of the institutional money in the world is now invested in alternative investments. And this number continues to grow. Just 10 years ago, it was 5 trillion US dollars. So 10 trillion US dollars has flowed into this alternative investment space in just the last 10 to 15 years. So there's been a tremendous growth in the allocation to these alternative investment areas. So we think of institutional investors as pensions, as sovereign wealth funds, as university endowments like Yale University, and insurance companies as well. And so what we see is that more than half of these institutional investors, according to Preqin, have an allocation to both private equity and real estate. So private equity and real estate are the most popular alternative investments for these institutional investors. But we also see that 45% are invested in hedge funds, and about a third have investments in infrastructure, private debt, and in natural resources. As we look at these institutional investors, again surveyed by Preqin, we see that when you ask them what their plans are, they say maybe we have too much in hedge funds. We're likely to reduce our allocation to hedge funds in our portfolio because the 10-year return to hedge funds is similar to the 10-year return on investment-grade debt. It's not that exciting, right? And we paid a lot of fees for not a lot of return in hedge funds over the last 10 years. But we see that 30, even 40% of institutional investors are looking to have more private equity in their portfolio. They're looking to have more real estate, more infrastructure, more private debt, and more natural resources in their portfolio. And so we're continuing to see increasing allocations across this alternative investment space, especially into these private equity and real asset categories. Hedge funds now have 3.2 trillion US dollars invested, but we're seeing that market somewhat plateauing. So since 2014, there's been zero net new investment into this hedge fund category. But what's interesting is while the hedge funds in the private space have plateaued, as you said, there's an increasing availability for small investors in these hedge fund type of vehicles. In Europe and the international markets, we call it UCITS, and then in the US market, we call them 40 Act funds. They're mutual funds available to retail investors with small minimum investment sizes. So in Europe, we call this market UCITS, and you see that this market's grown from 50 billion euros in 2009 to 450 billion euros today, and now you've got about $400 billion in the 40 Act funds in the US. So now, fully 1/4 of all the hedge fund money in the world is now in these daily liquid vehicles available to retail investors. So the private hedge fund market has plateaued at about that $3.2 trillion, but now there's almost 900 billion euros that are invested in these daily liquid vehicles, and you see the tremendous growth in this liquid alternatives space. When institutions look to invest in hedge funds, they want to invest in a fund that's institutional quality. They want to have a top brand name lawyer involved with the firm. They want to have a top brand name accountant involved with the firm. They want to have top software. They want to have good risk management. They want to have a good number of people in that fund that are being careful. And so what we see is that in the private hedge fund business, there's a significant consolidation in that business where the big funds are getting bigger. So we see that 27% of hedge funds have assets over 500 billion US dollars, but if you add them together, they have 93% of all of the assets. So it's very difficult to be a small hedge fund manager because when the pensions and the insurance companies, the sovereign wealth funds, and the endowments like Yale, when they come in to invest, they come in to invest in a very big way, and they're going to invest in the largest funds that have made the investment in proving that they're going to be careful and qualified to manage that institutional framework. Now, there's been a lot of bad news about hedge funds, and part of that has been low returns over the last 10 years. But to defend the hedge fund managers, which I don't always do, it's been a very difficult market over the last 10 years. So if you think about what's happened since 2008, you've had these bank bailouts, and you've had crisis after crisis, and you've had central banks injecting lots of money into the market at very low interest rates. And so we go from a risk-on fear market to a risk-off fear market. So you go from fear to greed, and everyone is either saying, I'm in stocks or I'm out of stocks. They're not making a selection of healthcare versus tech. They're not making a selection of large versus small. They're saying, am I going to be greedy and in the market, or fearful and out of the market? And so when you're making those market level decisions, it's really difficult for hedge funds. But the market's really changed in the last 2 years, especially since Donald Trump has come into play, right? And there's been a substantial increase in dispersion. So if there's a big difference between tech and healthcare, a big difference between large and small, a big difference between this stock and that stock, the hedge funds have a stock picker's opportunity to create more value. Private equity is also a growing area of investment, over $3.4 trillion US dollars. But one of the problems is that there's an increasing amount of dry powder in the private equity industry. And so we saw in the first slide that 30 or 40% of investors want more private equity. They want more infrastructure. They want more private debt in their portfolio. But the investors continue to allocate more assets to the space, but the fund managers aren't putting that money to work, right? So there's over $1 trillion of private equity money that's sitting on the sidelines waiting to be invested. Because what's happened is every year since 2011, there's been more exits than there's been capital calls and reinvestments. And so every single year, the private equity managers, they're having mergers of their portfolio companies, they're having IPOs of their portfolio companies, they're having sales of their portfolio companies, and when those exits happen, they return that capital to shareholders. The shareholders want to reinvest that money and put it back into private equity, but the fund managers aren't able to put that money to work, and we're concerned about the level of valuations of private companies. And in many cases, the private companies are valued at a higher rate than they might have as a public company, which makes it difficult for those companies to exit. A big change in venture capital in recent years. If you look back to 2013, you see that the vast majority of that venture capital activity is the blue line in the US, and then the red line in Europe, which was the vast majority of global venture capital activity. But you've seen just over the last 5 years this increase in the green line here in this chart, which shows now that there's more venture capital money being invested in China than there is being invested in the US. And a lot of that is being invested by the BATs, Baidu, Alibaba, Tencent, and SoftBank. So while there's a lot of European and American venture capital activity in China, a lot of that is from the Asian corporates as well. Dan was talking about David Swensen and the Yale Endowment, and different investors define risk in different ways. Some people define risk as standard deviation, some people define it as beta, and some people say there's a risk-free security, a short-term sovereign debt, right? But what David Swensen says is his investment goal is to be able to spend $1 billion a year out of the endowment to fund professorships and scholarships and buildings, and in 30 years have more money than he has today, adjusted for inflation. And so David Swensen says, my #1 risk is inflation. So we might see from some of these endowments that 10, 20, even 30% of their portfolio might be invested in real assets. Let's buy an oil well. Let's buy a gold mine. Let's start a solar farm for electricity. And we're going to make these investments. Because if we invest in real estate, if we invest in infrastructure and farmland and timberland, we believe that we will have a positive exposure to inflation in our portfolio. Remember, the stocks and the bonds, they suffer during times of rising rates and rising inflation. But when you invest in real estate, infrastructure, farmland, timberland, and commodities, we believe that that's going to have a positive exposure to inflation in our portfolio. It's been a substantial increase again in the assets allocated to private debt. We see this has grown from $100 billion US in 2005 to nearly $800 billion today, because we saw a number of banks fail in the US and in Europe in 2008. And after that comes the stress test and the capital adequacy requirements and Basel III. And so over the last 10 years, European banks reduced their lending to small and medium-sized companies by 500 billion euros. And so now these companies that employ the majority of Americans or the majority of Europeans cannot go to a bank and get a loan because the government says it's too risky. So where do these companies get their loans? They call the hedge funds, they call the private equity funds, they call the private debt funds, and they get their financing directly from these investors, which in many cases have been funded by the pension funds and the insurance companies. While venture capital is strongly moving to Asia, we see this private debt opportunity is still largely in the US and in Europe between direct lending, distressed debt, and mezzanine. Mezzanine funds the leverage buyouts, and then direct lending is when the company is going directly to the private equity fund or the hedge fund for that financing. Finally, we have real estate as an investment opportunity, and you could invest in real estate in a private structure or in a public structure. That public structure trades like a stock called REITs, Real Estate Investment Trust, and you could buy and sell it every day as an individual investor. And what we see recently is REITs are cheap relative to the valuation of private real estate. So large investors will go out and buy office buildings, they'll buy apartment complexes, or they'll invest in private equity funds that own the property directly. But we've seen that for most of the last 10 years, the private funds have outperformed the public funds in real estate, which leaves the private funds relatively cheap. We value real estate by this concept of a cap rate, which is the income produced by a property relative to its price. In the US, cap rates are around 7%, which you take a 10-year government bond of 3%, you add a 4% spread, and you come up with a 7% cap rate. So real estate is designed to earn about a 7% cap rate in the US. But we see that those cap rates vary around the world. We think that the most expensive market in the world might be in Hong Kong, where investors are expecting just a 3% property yield. So properties are very expensive in Hong Kong relative to the rental income that they earn. But people who live in Hong Kong, and it's explained to me when I travel there, that people don't believe that property is risky, even at very high prices, because they believe that rates in the US will stay low for a very long time, and that money will come out of China for a very long time. So if you challenge either of those assumptions, there's a big downside to that market. One of the cheapest property markets in the world might be office buildings in Frankfurt. If you think Brexit is going to happen, a lot of people are going to move out of London. They'll move into the continent. Maybe they'll move to Dublin. They'll move to Frankfurt. They'll move to Paris. And so we've seen vacancies in Frankfurt fall by 70% just in the last 3 years. So there's a significant upside in the Frankfurt property market. So this is my very short overview of the world of alternative investments. But Monica and I are at the table today, and we'd love to tell you more about what we do at CAIA.